All right, let's talk rate of return. Now that's why anybody's going to be doing any investing is they want rate of return on their money. If we didn't want return on our money, what we would do instead is just simply take the cash, bury it in the backyard, stuff it under the mattress. We need rate of return. Well, let's first talk about what it takes to calculate rate of return. To calculate rate of return, it's pretty easy. You're going to take your beginning of the year value, what you had, then you're going to take the growth of your money that year and divide it by what you started the year with. That's going to give you a calculation that's going to be effectively be a fraction or a decimal, and you're just going to make that a percentage. So simple math would be if you had $100,000 and then that year you had 10,000 of growth, you're going to take 10,000 divided by your beginning of the year value, 100,000. That's going to give you the calculation, if you did that on a calculator, of 0.10, and to make it a percentage, you're going to move it over 2 decimal places and put on your percent, and you're going to have a 10% rate of return that year. So that's how you're going to calculate your rate of return on your investments, no matter what kind of investment it is. Could be real estate, could be stock market, could be a bond. That's your rate of return. Now, what's going to produce your rate of return? Well, when it comes to stock market investing, there's no academic evidence that any individual can time or predict or speculate and beat the market. People try, and the problem is that the people who try are no longer around, like they've lost their mutual funds, or even if it's your friends that used to day trade and they were bragging about how well they were doing, they just don't talk about it anymore. And you can watch that in some of our other videos like The Illusions of Investing, where we talk about survivorship bias. So I would encourage you, if that's an area of interest for you or a place you struggle with that you think maybe you could beat the market, I would encourage you to go watch The Illusions of Investing. But for all of us, what's going to produce the rate of return in the stock market is basically our ability to do what we talked about in our last video, which is build an asset allocation model and rebalance and to tolerate volatility. You see, the reason the stock market gives us the return that it does over time is because we're willing to tolerate this volatility. If there was no volatility and all of the assets just went smooth and up and to the right, well, then they wouldn't pay us the rate of return that they pay us to be equity investors inside of all these companies. So what we have to do is embrace that risk. Every time the stock market goes up and down, I sit back and just sort of grin, because I know that's the market working and that the market's going to pay off for all of us that are willing to embrace and hold up to the volatility. Now, that's not the case with every area. Like real estate investing, part of what gives you your rate of return in real estate investing is you're bringing your human capital to bear. We're going to talk about that more in a future video. But for now, just know that there are things you can do in some other markets where it's your unique intellectual ability, your unique experience that's going to give you the ability to get higher rates of return. There is just no evidence that that bears true inside of equity and stock market investing. What we need to be able to do is go at it with an academic approach to get the greatest amount of rate of return with the lowest possible cost that we can, and that will allow the most amount of that money, that rate of return, to land back on your balance sheet, allowing you to design and build a good life.